Welcome back, everyone in YouTube land. This is your tinfoil hat economist coming back to you at the speed of light. Episode number 21, Four Big Bungles by America's Economists. Hey, let's get right to it. Bungle number 1, the inflation monomania. For about the last 40 years, I would say the bulk of the profession has repeatedly warned that we were on the cusp of higher rates of inflation and thus higher interest rates in the years pending, largely due to bigger federal budget deficits and too easy money. This concern, or crying wolf if you will, reached a crescendo in some regards in 2008 in the Federal Open Market Committee hearings of the Federal Reserve Board, where they decide policy, and the word inflation was heard hundreds and then thousands of times through the year, when in fact the U.S. economy was on the cusp of the Great Recession, the worst economic downturn since the Great Depression. And no, inflation never got out of control, and it sank down to the low single digits and perhaps soon into negative that we see in the current recession. So that was bungle number 1. And by the way, the Federal Reserve for years maintained that any rate of unemployment below 5% was intolerable, as it might lead to higher inflation. That is, 1 out of every 20 Americans who wanted to work had to be kept unemployed to fight inflation. Imagine all the lost production and agony of unemployed people in meeting this completely unverified idea. It's called the Phillips curve, which hasn't applied in decades. So on to bungle number 2, kind of a funny one, but in the United States, various regions have all but criminalized new housing production through property zoning. You see this in Los Angeles, up and down the West Coast, San Francisco, Seattle, New York, Boston. This housing inflation is about the only kind of inflation we have left. And in fact, without this housing inflation, rent inflation, Kevin Erdman of the Idiosyncratic Whisk blog, George Mason scholar, has pointed out inflation would be running around 1%, and even that might overstate it. But the economics profession has been more or less mute on this topic of property zoning. It has not become a cause célèbre, unlike bungle number 3, which is foreign trade and the massive U.S. trade deficit. No matter how large and persistent the massive U.S. trade merchandise or current account trade deficit is, the U.S. economic profession has sacralized free trade and cannot bring itself to discuss any methods for redressing the large and chronic current account trade deficit. Now, the International Monetary Fund has said that the capital inflows born of this trade deficit, that is, people have money and they bring it back to the United States, not by buying our goods and services, by buying U.S. bonds, treasuries, stocks, and property. This inflow has resulted in artificially inflated asset values, and you could get a Hyman Minsky moment when that inward capital flows are stunted, or people figure out that assets are really artificially held high. And why are they artificially high? In part because Europe and mainland China subsidize exports. This leads to an imbalance of trade. And when President Donald Trump implemented 10% tariffs on a single trading nation, mainland China, back in 2018, in May of 2018, more than 1,000 economists signed a public letter saying that Trump's tariffs would trigger a global Great Depression, just like Smoot-Hawley did. There's a number of historical inaccuracies in there, such as Smoot-Hawley was more or less toothless, and the Great Depression was probably caused by too tight monetary policy, but let it go. Mainstream economists have sacralized free trade, and they just go mute on property zoning. And the fourth one is this curious situation we are in presently, COVID-19. Governments around the world have not only triggered but implemented a Great Recession or Depression in an uncertain battle against COVID-19, and yet the macroeconomics profession has gone all but silent. There's no letter signed by 1,000 economists advocating perhaps an earlier end to lockdowns to promote economic growth. There's been no sensible cost-benefit analyses. There's been very little debate. In general, the lockdowns have been assented to, despite the fact that we are going to see the highest rates of unemployment in the United States since the Great Depression, and possibly exceeding the Great Depression. We might see 1 out of 2 private sector workers unemployed if the lockdowns do not end very soon. And where is the macroeconomics profession? More or less mute. What does this mean? These 4 big bungles. It means in the very time we need sound macroeconomic advice or insights or cause célèbres, it has been lacking from the U.S. macroeconomics profession. And those are the 4 big bungles. There may be more. That's all I can come up with off the cuff. And the 4 big bungles are, again, an obsession with inflation, a muteness on property zoning, the sacralization of free trade, irrespective of any other considerations, and now COVID-19. Where are America's macroeconomists? So this is your tinfoil hat economist signing off at the speed of light. Looking forward to seeing all of you in episode number 22 of the Tinfoil Hat Economist.